right, hey, what's going on, YouTube? A lot to catch up on. A lot of stuff happening in the investment world when it comes to Crocs. We've seen some stock decline here, or stock price decline, as a result to analyst downgrade that happened recently. So let's take things into perspective. We'll look at the chart real quick. Um, Crocs reported earnings right around here, and now we're sitting at right here, which is 87 or just shy, a cent shy of $88 a share. So from right here, from 119 to current pricing, we're about 30% decline on stock price. Okay, so not that good when it comes to um, where we're sitting as a stock price, but we're going to talk more about that. All right. So why did this thing go down? There's got to be a logical reason why downgrades and everything are coming. I did more research, and this is part of the game. All right. So let's look at it. All right. So the downgrade came from B. Riley Securities. An analyst, Jeff Lick, downgraded Crocs to neutral from buy at a lower price target of 101 from 125. All right. And I went through all this. I'll save you all the trouble, but he's pretty much saying the growth is slowing. There's warehousing issues and climbing inventory. He's insinuating that the growth will be flat next year, and there's not gonna, their growth is slowing and it's not good, blah blah blah. Which, in all reality, Crocs management did not. In fact, they upped their guidance for the year. They've continually beat and raised guidance, earnings after earnings. All right. So we go to Tip Ranks. All right. This is the website where you can look up analyst credibility. And as you can see, Mr. Jeff Lick from B. Riley Financial is a Wall Street analyst that's ranked 6,822 out of 8,562 with a 0% success rate and an average rate of return of negative 9, shy of 9.5%. So bottom of the barrel analysts, like they scraped this guy from the bottom of the barrel. He has no credibility. In fact, if you do the opposite, of what he rates on from his analyst research, you'd actually be beating getting 9% or above returns, which is pretty crazy. So that's one way to look at it. All right. Let's do a smell check on insider trading on Crocs with their management. Let me see. Yep. So as you can see here, from the time they reported earnings, July 27th, these direct buys, management, there's like few different members of management directly buying the stock. So whenever you see a direct and a buy, that's them buying the stock outright with their own money. Okay. The last person to buy was Treff Douglas, and that was on the 18th of August. Now, with the actual research that I've done, why is this all happening? Why are analysts coming out and downgrading this? All right. This is my thesis. All right. A few different reasons. All right. One or a couple different reasons. So this is one reason. This Birkenstock IPO is coming up. All right. I was wondering why, now things are starting to come to fruition. And this IPO has been in the making before it was actually announced to the media in the actual banking community or Wall Street community. So IPOs are a product of Wall Street, and what they do is they take private companies and they sell a portion of that private company percentage to the public in the form of shares. The initial public offering of shares is how they sell. All right, that's what that is. All right, initial IPO stands for initial public offering. So this stock is not a stock yet, but it will be coming onto the stock market. All right, and they're trying to sell this company for $8 billion. All All right, so let's look at this from a valuation perspective. They did 1.34 billion last year for their revenue. They saw an increase. Okay, so let's just say, okay, 1.3. Let's see, they're trying to sell for 8 billion divided by 1.34. They sold, that's about 6 times revenue. So you look at that. We'll give them a little bit of credit because that was last year. We'll say this year, we'll just say that they're trying to sell it for 5 times revenue. Okay, just to keep it simple. We'll factor in their growth. I've looked at this prior to recording this. All right, go back to Crox. If you look at Crox, let me see earnings. We're estimated to do 4 billion this at the end of this year, which is about to end in a few months here. So 5 times revenue for Crox would put Crox at a valuation of 20 billion from its current valuation of 5.42 billion. So let me see here. So divided by 5.42, 3 times 6.9 times 8.7. I'm gonna just do some quick math here. Bear with me. All right. So if you take that under perspective, they're selling. If we match the value, if Crocs match the valuation of the IPO, Crocs' stock price should be $324.68 or 69 cents. Okay, if you round up. All right, that puts Crocs at a 20 billion valuation. A little rich right now, anyway, and where we stand with the fundamentals. All right. Now, I think Crocs is worth about maybe $225 for my assessment, but that's just me. And that's another reason why I'm buying pretty heavy. So, and we'll get into that in my my actual position and what I intend to do and so forth. Now, that's that. I want you to take, I want you to understand how this works. An investment banker. People think that an investment banker just, I'm going to invest the rich's money and I'm going to make sure they make money and blah, blah, blah. That's part of it. They have portfolio management sectors, but a lot of investment bankers, when it comes to the IPOs, their job is to sell the company for as much as possible, right? So they assess a 5 times revenue multiple of what they're trying to sell to the public. You need people to actually buy the stock, though. Something's only worth as much as someone's willing to pay for it. If you look at Crocs, we're not trading at 5 times sales, which is 5 times revenue. In fact, we're trading at trailing 12 months or forward sales of 1.35 times. Okay, that's a steep regression compared to 5 times revenue. Now, if Crocs and all these other different shoe companies are trading at depressed multiples, why would someone pay 5 times revenue for this company as versus to this one? All right, and Crocs is arguably way better. I mean, if you look at, let's say if Crocs paid a dividend. I want to talk about how strong these earnings and free cash flows are. All right, so to take things under perspective, if let's look at Nike. Okay, they pay a dividend, and they use 41% of their earnings to pay the dividend on Nike, which comes out to 1.41% of the yield. Okay, so if we go to Crocs at 40%, if Crocs paid out 40% of their earnings, it would be about a 5.5% yield. That's a dramatic difference. It's like 4 times the amount, kind of. So, I mean, that's how strong Crocs' earnings are compared to what they're trading at right now. All right, so I'm getting way more bang for my buck. This is a problem for the IPO that is supposed to be set for October 9th. So, these Wall Street bankers, and they'll look at this and they'll assess that as a problem too. I mean, if they're smart enough anyway. So here's something to consider as well. I have a thesis that certain sectors of investment banking in Wall Street are starting to figure out that Crox has a lot of value. The value in Crox is a lot. So what they'll do is they'll dump the stock. They'll come in, they'll short it, they'll dump it, just to allow the inflows of investing institutions to come in and buy the stock. All right. So let's look at this. We'll go to the statistics. We'll look at their short float. All right. Here it is. August 31st. The short percentage float is about 14.14%. Who knows the accuracy of what it is right now in September 17th when I'm recording. But I wouldn't be surprised if this thing's like 20% right now. All right, what's up, Lestat? Here, okay. So, all right. So here's the thesis. All right, the Birkenstock company, they go to Wall Street. We want to IPO. We'll pay your fees, whatever. Just get us on the market. We want to raise, however many, several million, hundred millions of dollars to pay off debt. That's the reason why we're IPOing. So get us a valuation of $8 billion. All right. And Wall Street says, yep, that's our job. That's what we're going to do because we want to make absurd fees off, companies going public. All right. So they're setting this up. They look at all the other shoe companies and they say, okay, these are what the companies are trading for. And then they start knocking down the value. So what they'll do is say, and this is a thesis of mine, I can't confirm this, all right, but proof's in the pudding, actions speak louder than words, all right? You can do the math, all right? So they get a hold of some sort of investment analyst firm, and they say, I need you to downgrade the stock. We'll do a short, which is they'll borrow shares and sell the stock, and they'll manipulate the price to go down, all right? So they'll get some nothing burger, bottom of the barrel, scraped out of the bottom of the barrel analyst like Mr. Jeff Lick to downgrade the stock because, hey, why not? He's got no reputation to lose anyway. All right. So he'll downgrade the stock. Hedge fund comes in, shorts the stock and sends it down. All the dumb, scared money will exit out because they don't understand what value is and how much of a yield they're getting on their money. Financial institutions, the smart money that knows, that got a hold of the actual Mr. Jeff Lick and B. Riley Financial to initiate the downgrade for the hedge fund on the other side to come in. They're coming in and buying the shares cheaper. So I bet financial institutions are buying heavy into Crocs when we're down at these depressed levels. All right. When shorts cover, they're going to push the stock up. When they cover their short now, they sell it, it goes down, and then now they have to buy it back. And when they buy it back, they put more buying pressure to push the stock up. So it's a dump and then pump, all right? When it's a pump and dump, all right, it's like when some investment banker is trying to sell some overpriced piece of crap to the market, and then people start realizing, oh, this is crap, and then they start selling it, and it goes down, all right? Because they get a way better deal elsewhere, all right? Something's only worth as much as someone's willing to pay for it, all right? So there's that to consider. So this IPO set to go on October 9th. That's going to play a factor. Now, this is what I think might happen. I think there's a possibility that Crocs will start rallying, like the stock will start shooting up. All right, there's got to be some catalyst. So these investment bankers, they're smart enough. They'll try to push up the valuations to support the IPO selling. So when the market does comparisons of different shoe companies to this company, they'll buy the IPO because they need the exit liquidity for their investors that are trying to sell a portion of the company to go public. Remember, you need someone to put up the money to buy the shares, right? So there's some catalysts that, one catalyst that I suspect that might trigger the rally of Crocs is Nike's earnings. So we'll go to earnings. They're set to do earnings on September 28th. Okay. So that post market. So after close of market on September 28th, which is next Thursday, Nike's report earnings. I think there's a decent chance that, unless the macro conditions are bad, Wall Street might push up these shoe company valuations. All right. Maybe not Nike, maybe so, but Crocs may start rallying because they're trying to sell this IPO. Maybe, maybe not. I could be wrong, but either way, this is how Wall Street works. They might do this might be the catalyst that triggers that, or it might be something else. I'm not sure. All right. They got the keys to, they really are the ones with the inside information. I'm just a retail investor. All right. So let's talk about what I'm going to do, or what I'm doing with the position. All right. So my prior videos, I said that I was going to commit to doubling the position, and I've been aggressively doing just that. I'm not done yet. I own 176 shares, cost basis $18,079, and is at an average of 102.72 a share, $102 a share. We're down 14%, which should not last too long. Good chance this stock goes into the 70s if they continue to dump it and then have more people come in, or more institutions to come in and buy it and manipulate the price. But this is what I intend to do. I'm going to cop this off at 200 shares because the percentage of my portfolio to this one stock is getting up to levels to where I don't know about all that. Like, I'm not willing to take more risk than more than 200 shares. Just for the simple fact that I don't want to have, at this point, I'm kind of betting a portion of the farm. And there is other positions that I want to build out. So I'm not done buying. As you can see, I've been buying pretty aggressively at a 15% compounded rate for the position size. All right. So yeah. So from the last earnings, we've been buying a big chunk worth. All right. So I'd probably do one more buy order, top this off at 200 shares. I'm a little low on cash buying power right now, but I'll get some more and then finish this off. All right. So, hey, if you're getting that, I know this was a long video. Hopefully you learned something and got some value out of it. Thumbs up, like, and subscribe. I appreciate all my subscribers and everybody showing support. Thank you and have a good day.